All right, and let's see, let me get this rolling. All right, I see that we're somewhere around the 10 mark for folks enrolled in the BMC, so just kind of a reminder, that's only a quarter of the class. It's coming up. It's going to be March before you know it, and March 14th is the deadline for doing those first 3 modules. So don't forget to get in there and get those modules going, because as soon as the midterm is done, we're going to jump into this security analysis project, and you're going to start getting overwhelmed with work on that. So get this done, get these 3 out of the way. There's still a couple more coming up. I think I've got another 3 in the second section. So 6 altogether out of the Bloomberg Market Concepts. It's a lot of fun, actually, once you get into it. I think those of you that have already started it hopefully are enjoying that set of modules. So please try to get in there and get at least get started on it. Get the class code in. I did put up a brief video about what I was finding in terms of being able to access the BMC outside of the context of the terminal itself. So make sure you take a look at that. I sent out an announcement a couple of days ago about that. And let's see, what else? Any other questions so far? Everybody's all right at this point? All right. One other announcement that hopefully will work for you all. I talked about pushing the midterm off till next week, and so I still had not specified a day yet. So we're going to make it Thursday. It's going to be March 4th. Thursday is going to be the day of the exam. So that gives us 3 more days to work on the rest of this material. Today, I'd like to finish up talking about Chapter 5, and then we'll get into some of the exercises that relate to Chapter 6, which is the valuation stuff, and then Chapter 5 as well. There's some short exercises on constructing indices and figuring out how those things work. All right, so now I need to shift gears over to... all right, so we ended class last Thursday on this Kudlow and Kramer video, which was rather, well, very in your face from both, in particular, Mr. Burns and Kramer. So let me talk a little bit more about that, what they were discussing there. What they were actually getting at was this idea of a Dutch auction. Kramer referred to it as Dutch treat. I don't know why. That's, I guess, just his little term for it. But the economists have a variety of auctions that they study. So there's actually an entire field of economics that relates to trying to understand the best method to get a proper price for something. So you think of the English auction, which is the auction that you may be more familiar with. So we start at a low price and we work our way up, and the last person left at the highest price, that's who gets the item. So this is typical of what you would see at any sort of auction on a house or equipment or estate sales, that sort of thing. In fact, that's the type of auction that Christie's does too, on artwork and automobiles and things of that nature. A Dutch auction works the other way around. We start at a very high price and we work our way down to a lower price. And the way that works when we're talking about securities is, hang on just one second here. The way that works when we're talking about securities is that we have thousands or millions of these securities that are all identical to one another. And as a result, what we can do is we can have sealed bids. And I'm going to jump into the Blackboard here and give you an example. So if we're trying to do a Dutch auction for shares of a company that's doing an IPO, We don't know what the correct price is, but we're going to use the crowd, if you will, all of us submitting our reservation price. Now remember, in economics, a reservation price is the value that you place upon something. My reservation price for an item may be different than yours, may be different than your classmates, and may be different than your roommate's reservation price. But each of those relates to some sort of value judgment based not only on the thing itself and the characteristics of the thing itself, but also upon our individual utility function. Remember back from Econ 101, a utility function is what is inside our heads when we do that calculation that says, yeah, this is worth $10 to me, or no, this isn't worth $10 to me, it's only worth $8 to me. So that's how we come up with this reservation price. And so the idea behind auctions is to try to get us to reveal our reservation price. Now, I'm not going to reveal my reservation price willingly without getting something in return, because that reservation price has value to somebody else. I'm sure you've heard the classic example given of, somebody going into a 7-Eleven to buy a bottle of water for $2.50, and you don't know whether that individual just got out of a car, an air-conditioned car, or whether they just walked out of the desert and had been in the desert for 3 days. That second person, obviously the reservation price for that bottle of water is quite high, right? So if you could price discriminate, if you could tell and say, well, this person just came out of the desert, that's worth about, $5,000 to them, and they probably willingly pay it, versus the person who just drove up in an air-conditioned car. $250 might even be too high. So you get the idea. So what we're trying to do is we're trying to get the person to reveal this. So how do we do that? Well, we give back something, and that's what the Dutch auction is good at doing. So a Dutch auction might take form like this. Let's keep the numbers simple. Let's say that we just have 100 shares of XYZ stock, and we're trying to do an IPO with that stock. So we seek a bunch of sealed bids. So you're going to submit a bid, I'm going to submit a bid, we're going to get dozens of other people to submit their bids. Not only are they going to submit a bid, but they're going to tell us how many shares they would like at that particular price. And so here I submit a bid for 10 shares at let's say $100. And you submit a bid for 20 shares at $90. Somebody else submits a bid for 50 shares at $85. And then we get somebody down here submits a bid for 30 shares. Let's see, 50, 70, 80. Good. And then we get somebody down here who submits a bid for 200 shares at $65. Now remember, we don't see each other's bids. They're all in a sealed envelope. And when all the bids have been brought together, the person managing this auction opens up these bids, and here's what they see. So, what they do is they first rank order from highest down to lowest bid. And then they go over here to the number of shares that are requested at that particular price. And they start subtracting those shares from the total shares that we would like to issue. So out of these 100 shares, we're going to take 10 off the table, so we're down to 90 left. Here we take 20 off, so we're down to 70. Here we take 50, so we're down to 20. And here, this one, they wanted 30. There are only 20 shares left. So we're going to give them 20 shares. They're not going to get all 30 shares. Now, here's the give back. Here's why I'm willing to reveal that this thing is worth $100 to me. You're willing to reveal that it's worth $90 to you. Here's why. Because the selling price for all 100 shares is going to take place at that lowest price where we had an allocation. So everybody, including even me up here, I'm going to pay not 100, but 75. You're not going to pay 90, you're going to pay 75. They're not going to pay 85, they're going to pay 75. And of course, this person who bid 75 will pay 75, but they will only get 20 out of the 30 that they requested. We will get all of our allocation that we requested. All 100 shares clear, they all sell at 75 bucks a share, and we're done. Now, a lot of study has been done regarding the efficiency of this type of auction vis-a-vis other types of auctions, English auctions in particular. And they find that, generally speaking, it looks like Dutch auctions cause people to more accurately represent their reservation price. And as a result, this results in a higher value, or at least a fair value for the particular item that's being sold here. In this case, shares of XYZ. So that's a Dutch auction. So what? Let me go back to the. Back to Barnes with Overstock. So Barnes, when they did the IPO for Overstock.com, they did it as a Dutch auction. Google actually was the big kind of the original Dutch auction offer. So Google went IPO and they used a Dutch auction. They did it on the Google site. So when you went to google.com to do a search, you could also submit an order to buy shares of Google in the IPO. And you would submit number of shares and the price that you're willing to pay. And they did exactly what I did in that example. Obviously, there were millions of shares instead of just 100 shares, but that's what they did. They rank ordered from high price down to low. And then wherever they sold the total number of shares, that's where they drew the line, and that's the price that everybody paid, even if they had bid much higher than that. So Google did this, Overstock.com has done it. There have been other companies that have done Dutch auctions. And while, Patrick Burns is not incorrect that they are cheaper, yeah, absolutely. But not every company can do an IPO this way. Now, maybe a company like Uber or DoorDash or other companies that we're already very familiar with, they're already a household name. Sure, that's probably a good way for them to do an auction and to do an IPO is through that method. However, remember, the investment bankers bring a distribution network to the table. They bring marketing. They bring valuation skills to the table that you don't necessarily find in a Dutch auction, especially if the company that's going public is not a household name, is not very well known. You're not going to have all the bids. So while I certainly take some, they certainly have some point. The comments, though, about Wall Street and the investment bankers and the IPO process being a scam and a ripoff and all of that, no, I'm sorry. They're a little extreme on their views of that. Yes, they are charging premiums, and yes, they do. The investment banks do make a lot of money off of IPOs and off of seasoned equity offerings, but they also bring a lot of value to the table. In terms of the fee structure, let's equate that fee structure to real estate. What is the typical real estate commission? Anybody know off the top of your heads? Have you helped buy or sell a house or watch your parents do that? Anybody know what the real estate commission is? Typically 6%. And that's pretty much no matter where you go. 6% is kind of the number. Well, and at first you might go, well, they're colluding, especially in this market. You look at Howard Hanna has what? They must have at least 60% of the market here, right? So they could kind of be the price setter. But you go to other markets where there's more competition, you're going to see that same 6%. And so, yeah, well, I'm certainly not saying that it's impossible that there isn't some collusion price setting, which is illegal, mind you, going on there. But generally speaking, it's pretty costly to sell a house. A piece, especially a residential piece of real estate, is fairly costly. And if you want the proper marketing and you want the proper valuation, it's probably good to go through a real estate broker and a real estate company and pay that 6%. Now, if you know a lot about valuation, if you know a lot about marketing yourself, you can do it yourself, but it's still going to cost you something, and it's going to cost you time as well. So this FSBOs, for sale by owner, FSBO, that you'll see, yeah, they sell their house and they do it for less transaction costs. But what might they be missing? So let's say they do it for 3% instead of 6%. That's a deal, right? Why might it not be a deal? Paul, any ideas? All right. How about Spencer?
I'm not sure.
Okay. Anybody want to take a wild guess? What else could go wrong in this deal?
It could not fall through.
Yeah, that's not what I was. That's not the direction I was thinking. But you're absolutely right. Yeah, if we don't know the market very well, it could fall through. Maybe because we're not completely at the top of our game in terms of selling residential real estate. It's not easy by any stretch. A lot of legal issues to deal with. There's something else though that relates to value. What if I'm not getting top dollar for my house? Yeah, I only paid 3% instead of 6% as a commission, but instead of getting 200,000, I only got 170. Maybe I didn't know the value. Maybe I didn't negotiate properly. For whatever reason, I may not have gotten the same value. So am I really saving money? No, not at all. It's actually costing me. And in fact, you'll see this also when it comes to trading, whether you're trading on the NYSE or the Nasdaq or some third market. There's this whole question about getting the best price. And by best price, I mean if you're buying the lowest, if you're selling the highest. The NYSE argues that its market structure and the method that they use to develop price is more efficacious than any other market structure. And they may have something there. Yeah, you're going to pay a little bit more in terms of commission and spreads, but you may also get a better price. And that may more than offset the additional transaction costs. So that's a real problem with this idea that, yeah, Wall Street's a ripoff. Everybody ought to do the Dutch auction, or as Kramer says, Dutch treat way. No, I'm sorry. That's not true. Now, believe me, and this is opinion, obviously, but I'm not the finance professional who says, well, if it's in the market, it's got to be right. I don't necessarily subscribe to that. But in this case, yeah, I think ultimately it's not that far off the mark. Should it be 6% instead of 7% if we were in a more competitive marketplace? Maybe so. I mean, we could quibble about that. But in terms of should everybody do a Dutch auction? No, the answer is no. These guys are off the mark by a long shot. But I thought it was an interesting debate that they had and discussion. All right, so on to some other elements here in Chapter 5. Something that is seemingly up and coming here is this idea of crowdfunding. And in particular, when we're talking about relatively small firms and as a replacement almost for venture capital. Um, so for firms, from the firm perspective, I think this is probably a really nice innovation. From the investor's perspective, I'm a little more hesitant because these venture capitalists, 90+% of the firms they invest in flop. You've got to spread your money over a large number of firms in order to find that one firm that makes up for the losses on all those others that never made it. And so as a result, this crowdfunding can have a significant risk to the investor, especially if you're not very diversified. If you're just putting a small amount into a small number of companies, more than likely you can expect to lose it all. No question about it. Sort of like investing in wildcat oil drilling. I mean, yeah, you invest in one well. What are the chances that you lose that money? Really high. Same is true here. Now, crowdfunding as a concept, though, I don't want to discount it by any stretch. I think it's got some good credibility and probably has some legs here in terms of sticking around. So the crowdfunding has been in the past limited to these accredited investors. That is, you had to have a net worth of at least $1 million or a income of at least 200,000 for the last 2 of 3 years. Now, with Reg CF, though, implemented, actually now the caps in terms of accredited investors are off. So any of us can actually engage in that sort of crowdfunding investment. They give you some examples here. There's a cutoff at 107,000. But even below that, you can actually invest in these crowdfunding ventures. I've posted here a link to the SEC page. There's a table based upon income and net worth that you can use to figure out how much you can invest in any given year in one of these crowdfunded endeavors. And by the way, this is all run through FINRA, which is this quasi-governmental nonprofit that oversees the financial industry. It's a financial industry regulatory agency, or authority, I think is actually what the A stands for. So that's an interesting alternative means, and I would categorize that into what is broadly called the fintech world, right? Fintech being a merge between finance and technology. So this is something that falls into that realm, and we're going to be seeing more and more fintech innovations in the world of finance. Another one of those things are initial coin offerings. So ICOs have been fairly popular. I've been doing a little bit of reading. I honestly can't say that I am anywhere near as expert on ICOs as I am on other things, investment or corporate finance wise. But it does appear that ICOs have kind of tapered off a good bit. I've got to do a little more digging before I can say for sure, but it doesn't look like they are quite as hot as they were just only a couple of years ago. Is that COVID related? I don't know. Only time will tell on that. But ICOs are another interesting means of raising capital. Sometimes a coin or a token can be used in exchange for a service. Other times it's actually just an equity stake in the firm itself. So in terms of that, I think that, again, that also has some good potential. And we're not talking about these large offerings. They'll still probably go the more traditional route of an IPO. But, if you're starting up a small company and you're looking for funding outside of family and friends, you've already exhausted that and your own capital, then you might reach out to things like the crowdfunding or the ICO type markets. Of course, ICOs are all built upon blockchain technology. And to my way of thinking, it's not so much the ICO or cryptocurrencies like Bitcoin or those sort of things that are the more important. To me, the most important part of this is the blockchain technology. It's the ability to have a what appears to be, and again, there's the jury is still out in terms of the security of these things, but it appears to be a very transparent and very secure record of transactions. And this can be used in a variety of ways. And again, you're going to see, I'm sure, over the next decade, tons of innovation related to use of blockchain technology to lower the cost of transacting in a variety of markets. In fact, some of you folks will more than likely be involved in those sorts of innovations. So blockchain is definitely something to keep an eye on. Now, Bitcoin, now that's a whole different animal. We won't get into a discussion of currency and the quality of currency, but that's more of a money and banking, financial institutions type class discussion. But certainly something interesting to look at. You know, I'll just give you a little hint of it. One of the features of a good currency is a store of value. Is Bitcoin a good store of value? Take a look at the price plot on Bitcoin and get back to me on that. Tell me whether it's a good store of value. I don't want to put my retirement funds in Bitcoin. Now, you might say, well, you know, there's this big run up. Yeah, there have been. And there have been big drops off a cliff, too. So, you know, as far as just one of the key characteristics of a good quality currency, store of value, it doesn't meet it. Now, as a transaction device, yeah, it's great as that. And in fact, it reduces the length of time that it takes to do electronic funds transfer, EFTs. So that sort of thing, yeah, it's really good at that sort of thing. But is it a store of value? No. Is it a replacement for the dollar at this point? Not even close. But this blockchain technology, definitely you'll be hearing a lot more about that. We've already talked a little bit about this, but this is the chapter where they really, give you the details. Okay, bid and ask price. Remember, this is the price that the dealer or the broker quotes. So the bid price is the price at which they will buy. So you can think bid is a B, buy is a B. If you're confused on that, just use that mnemonic. Ask price, obviously, this is what I'm asking for it, so that's the selling price. And remember that we as the investors face the opposite side of that. And the idea that this bid-ask spread, or just the spread, is the revenue stream to the dealer or the broker, and it's a cost to us. So a round trip, that is, if I buy something and then turn around and sell it, I pay the spread. The dealer or the broker gets the spread. That's what is their that's their income stream. The other interesting thing here about spreads, and again, spreads have continued to decline. They have gotten very, 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 very thin. Part of that is the result of huge volume increases over the last decade to 2 decades. But we can split up the spread into 3 primary components. One of them is quite obvious. It's order processing. It's paying the dealer to be there all day. It's paying for their computer systems, whatever else they need to be in the market, and quoting a bid and an ask price. The second one is reasonably obvious. They have to keep an inventory if they're a dealer, right? Brokers don't keep an inventory. They simply match up buyers and sellers. But dealers actually are buying to put into inventory or selling out of inventory. So as a result, there's a cost to that. I mean, I've got to fund my inventory somehow. So if I have tens of thousands of shares of a particular stock at any given point in time, that's tying up my capital. So there's an inventory cost element. This last one is probably the least obvious of the components that make up the spread, but it's still very important, and that is the adverse selection component. Anybody heard that term, adverse selection? Nobody? let's say that I'm going to use healthcare. Let's say this is actually happening in our marketplace today. Let's say that there were no pre-existing condition constraints on health insurance. In other words, insurance companies could not refuse you if you had a pre-existing condition. So when do I get insurance? Before or after I get sick?
I'd say if they didn't know, you'd probably get it like after, so that they can cover you then. Because they wouldn't know that you had a condition, so then you would only pay for it if you needed it.
Right, exactly, Kristen. Thank you. Yes, that's adverse selection, right? If insurance companies have to write insurance regardless of pre-existing conditions, then I'm only going to get insurance when I actually need it. If I'm well, I'm not going to bother. So that's the concept of adverse selection. So the insurance companies know that the folks who approach them to buy a policy, more than likely they're sick. More than likely I'm going to have a claim payout right away. So what am I going to do with my premiums? Jack them up. So that concept, adverse selection, is we see this all over financial transactions. In this case, and by the way, we could go on a whole discussion about why we actually need to have some sort of requirement that health insurance, that all people carry health insurance. It's not unlike the idea that almost every house that you see around you in your neighborhood, almost all of those folks have fire insurance, protection against if their house burns down. Why is that important? Well, it's important because I can't tell, if I'm an insurer, I can't tell which house in any given community is going to burn down, but I can look at the statistics and I can say that at least 3 houses in that town are going to burn down to the ground and be a total loss in any given period of time. If I know that it's 3 houses and I know the average price of a house, I can figure out what the premium is. Simple, easy peasy. Add up the value, divide by the number of premium payers, and as long as everybody's paying, that works pretty well. And it keeps my premiums down. Same is true of health insurance. If we are going to prevent insurers from not issuing policies to people with pre-existing conditions, or if we're going to require them to issue policies to any comers, we have to have all people in the community in that pool. Then the insurance companies can figure out what the actual premium is, because whether any one individual is going to get sick, that's a probabilistic thing. In a group of 1,000 individuals, we can be pretty sure that one person is going to come down with whatever disease, and it's going to cost on average that amount. We take and add all of that up and divide by the 1,000 people, and we come up with a premium. But that's all the further I'll go in that. As it relates to this, though, where's our adverse selection coming from in a stock?
One party might have more information on where it's going in the future than the other, so they might sell it at a different price.
Exactly. Thanks, Alex. Alex or Alexander?
Alex is fine.
Alex, okay. Yeah, absolutely. So even if I'm the dealer for this stock, I'm pretty well informed. There might be somebody who's better informed. And as a result, the quotes that I'm putting out there, if I'm quoting an ask price of $50 and somebody knows, no, it's actually 45, so I'm going to hit the ask all the time. I'm going to start buying, or rather, excuse me, on the ask, it should be the other way around. If I'm quoting an ask price of 50 and somebody else knows that it's actually 55, they're going to go out and place buy orders all the time, right? They're going to buy at 50, knowing that it's really worth 55, and eventually it'll get up to 55 and reflect that value. So that's adverse selection. So the idea that somebody that is better informed than the dealer is going to approach the dealer with orders is what they're trying to protect against. Oops, sorry, I let that screen flip over. So that's adverse selection. By the way, I do want to emphasize this is a concept that you'll see over and over and over again. Adverse selection and moral hazard are two very related concepts here. So adverse selection is this idea of a party approaching that might be better informed. Moral hazard is a little different. I'll give you a personal example. I've had a Volvo station wagon for many years. I know it's classic college professor drives. No, other reasons. I've got a dog. I like to go out into the mountains, the backcountry out in the West, that sort of thing. Those cars are awesome for that. But nevertheless, they're also known as extremely safe cars, right? So I buy that Volvo, and I don't think anybody's died in a wreck in a Volvo or a BMW for some time. So I'm gonna cheat that red light. I'm gonna be more aggressive in my driving because I know I'm gonna be safe. That's moral hazard. One other key factor I forgot to mention. I also have insurance, right? Since somebody else is going to pay if my car gets wrecked, as long as I walk away, hey, not bad, right? That's moral hazard. So those two concepts are very closely related, and we find those showing up in many of our transactions when we talk about anything finance. So always keep in mind, what sort of adverse selection might there be going on in a particular transaction, and is there a possibility of moral hazard? Adverse selection is a priori, meaning it's something in advance of. Moral hazard is something I do after the transaction. So, I look like I'm a good driver according to the insurance companies, and then once I get insurance, then I drive like a maniac. That's moral hazard. I don't drive like a maniac, though. I promise. All right. Let's talk a little bit about some of the more details about the structure of the NYSE. NYSE has been around for over 200 years, and they went public in 2006. Prior to that time, it was a partnership, basically. So there were 1,366 seats, they called them, in the exchange. So owning a seat was owning an ownership stake in the exchange itself. It also gave you the right to go onto the floor of the exchange and buy and sell stocks. But in 2006, they got rid of that structure and became a stock company. And it was traded on, of course, the NYSE. In 2007, shortly thereafter, NYSE was merged with Euronext. And then in 2013, the NYSE Euronext was acquired by ICE, the Intercontinental Exchange. And to this day, it's currently owned by ICE. And like I mentioned, there was this idea of 1366. I'm not sure where they came up with that number. Actually, a seat on the exchange, the value of the seats on the exchange varied significantly over time. It was up as high as over $1 million and dropped down, I think even at some point, well below $100,000. Here, sorry, I didn't see my own slide here. Here, 4 million record price. They still have a limit to the number of people on the floor. And what you'll see in the photos that I have later on in this slide deck is that there are nowhere near that number of people on the floor these days. The exchange is almost a ghost floor. There are very few members on the floor itself anymore. Most of the activity has gone online. Now, again, more of the details about how things are traded. And the reason this is important for those of us who are students of investments and finance in general is that how a particular market is structured helps to determine whether that market is going to produce an efficient price or not. And the NYSE, if nothing else, one of the things that they pride themselves on is price efficiency and coming up with a fair price in the quickest fashion possible. And up until 2009, a large part of that differential relied upon this individual on the exchange floor called the specialist. Now, a specialist was the sole dealer for a particular security. They had a monopolistic hold on a particular security. Now, if it was a smaller cap security, they might have had several that they were monopolistic dealers for. A bigger security, they may have just been the one person. Securities with massive volumes, there were a few where they even shared with multiple specialists, but that was the exception. So a specialist was the sole dealer. It was the only person who could quote a bid and an ask price, and they would buy and sell out of that inventory. They had some obligations to the exchange, and remember, the exchange is a self-regulated organization, an SRO, meaning that the exchange regulates itself so as to prevent the SEC or any other federal authority from coming in and regulating them with a heavier hand. So the NYSE itself put some pretty serious obligations on the specialists and monitored them constantly. Now, the obligations were that they ensured that there was a bid and ask quote at all times. So they had to quote both sides of the market. There were some details about they didn't have to, it wasn't 100% of the time, but there had to be quotes on both sides of the market, significant portion of the time. They also had to maintain price continuity and avoid sudden jumps in price to the degree that they could. They could not trade ahead of a customer's trade. So they couldn't jump in front of another broker or dealer coming up on the floor. And they could not trade in a means that would destabilize the price series. And remember, the NYSE had a group of people upstairs that were watching for this sort of thing. And they would look back historically and try to determine, hey, did the specialists actually do these things? And if they didn't, boom, they're out. Now, the specialist in exchange had some rights. Only the specialist knew the book. And the book that we're talking about here is the limit order book. I'll show you that in just a second. The limit order book gives you a lot of information. And so the specialist was better informed on the limit order book. They also got first look at incoming orders. And again, that gave them an informational advantage. It helped them to set the quotes properly. Now, I think it was 1997, I visited the floor of the exchange and I wandered around with one of the specialists for half a day and then and hung out with the dealer for the other half of the day. And so this was the period of time when the specialist had his laptop, and that's where the book was. The book was kept on his laptop. He kept the screen down to prevent the crowd, and it was pretty crowded in those days. There were quite a few people on the floor. It was packed, shoulder to shoulder. And so the specialist would keep that laptop open, but keep the screen down and only occasionally look at the screen to get an idea of where prices might go and to update his quotes. So that limit order book, it was very valuable. And if you were in the crowd, if you were near that specialist, you might get a glimpse of that limit order book. You might also get some sense from the rest of the crowd. So that's what I mean about this price efficiency and how that can be beneficial to have face-to-face interactions. I'm I'm questioning whether we don't lose something in price efficiency. The jury is still out in terms of the research. Nobody has proven one way or the other. So I don't want to. I don't want to say that it's worse, but I do wonder. It seems as though we're losing something there. Now, as far as what is a limit order book, let me show you here. This is Webull, and they have, pardon me, they have what are called level 2 quotes. This is actually for Nasdaq, but you can have a limit order book in any market. Any of you familiar with level 2 quotes on Nasdaq? Oh, Zachary? Okay. So here's an example, and this is just their advertising, so this is not real. I did sign up for a free trial on their level 2. I haven't signed up for the level 2 on a permanent basis, though. Here's an example of a graph that shows you what level 2 are. But let me just give you an example using a static set of quotes. So what we're going to find is that we might have an ask price that is, let's say it's $50, and a bid price that is $49. So we have a spread of $1. So the dealer is making $1 on every trade, every round trip. So they will buy at 49 and they will sell at 50. Okay, so those are what are also known as the inside quotes. And this is really true more on Nasdaq, but you can even think of them as inside quotes in the context of a limit order book, even on the NYSE, where there's only a single dealer, or at least in the days of the specialist, that was the case. Okay, then we might have some other quotes up here, let's say 51 and 52 and 54, 56, and we're actually going to have some volumes as well. So let's say it's 1,000 shares here, 10,000 there, 50,000 here, and 5,000 here. And then we're going to have some prices down here too. All right, so these prices up here and these prices down here are based on limit orders. Okay, so what's a limit order? A limit order is an order that any of us might place. And what that limit order says is, I don't like the current price that's quoted by the dealer. I don't like 49 or 50. If I'm a buyer, I don't want to buy at 50, but I'm willing to buy at 48. If I'm a seller, I don't like the price to sell at 49, but I am willing to sell at 51 or 52. So I've put in these orders that if the price ever gets to that point, it will execute. And I've done that ahead of time, and then I can walk away. Now I can place a time constraint on that. I can say good till canceled. I can say good for the day. I can say good for 2 days. Those are the typical types of time limits that I might place on an order like this. And so all of those orders, my order, your orders, the entire market gets accumulated, and this becomes the limit order book. So this is the list of prices and number of shares demanded at those particular prices. So there are 1,000 shares that are at 51 and 10,000 at 52, and 50,000 at 54. Down here at 48, there are 100,000 shares demanded. And at 47, 200,000. And at 44, 20,000. So you get some idea of how far the market can move in any given period of time. Let's suppose that the average volume per hour is 10,000 shares. Okay. So is the market going to move much above 54 or much below 48? As long as these limit orders are in there for a while, chances are pretty slim that it's going to move outside of those boundaries. So that provides me with a lot of information. I can see how far the price might move in any given short period of time. And usually limit order books are much more extensive. They go much further up and much further down. But that's where the informativeness of this comes from. When I mentioned here the Nasdaq and the inside quotes, in the case of a Nasdaq, in the case of the Nasdaq has multiple dealers. So they don't just have a specialist. They have dozens on the bigger stocks, dozens and dozens of people who will quote a bid or an ask or both. And they'll be willing to buy and sell out of their inventory. So instead of that single person that has all of the order flow coming through that one individual, they have dozens of people. The model there suggests, hey, their argument is, look, we've got a bunch of people here. We can soak up any disequilibriums. The argument that the NYSE makes is, we've got one person here and they can see all of the order flow, so they have a better idea of where price is going and what a fair price is. Again, the jury's still out on which is the better marketplace, and which comes up with a more efficient price and more quickly adjusts to any new pieces of information that may pertain to the value of the stock. Questions about limit order book or any of that? Okay. 1997 began the shift. Prior to 97, prices moved usually eighth of a dollar. In some cases, if it was a lower price stock, if it was what was called a penny stock, a low share price, it might have moved in sixteenths of a dollar. But most regular stocks moved an eighth of a dollar, up or down. So 12.5 cents. So you're either trading at $10 or $10 and 12.5 cents, or $10.25, or $10.37.5. You get the idea. There was no price at $10 and a penny, or 2 pennies, or 3 pennies, or 4 pennies. So spreads would jump based upon that 1/8 of a dollar. There was a great debate as to whether we should decimalize the market, and some of that debate still is ongoing. There are some reasons that the folks saying against decimalization were saying essentially that limit orders can easily step in front of another limit order, even though they didn't have time on their side, and that would reduce the quality of the market. I don't know. Like I say, the jury is still somewhat out on that, but we are decimalized. It's a fact of the matter. So between 1997, I think it went all the way to, don't quote me on this, but I think it was around 2003. There were about 6 years there where we made the transition. Could have been 2001. But they did it in tranches. So they said, okay, well, let's let these 1,000 stocks start trading in pennies. And then we'll let another 1,000 stocks trade in pennies. So this decimalization was a very big change to the marketplace, because prior to that, they traded in eighths for hundreds of years. What happened when we traded in pennies now? Spreads declined. Revenues declined, but there was also a concomitant increase in volume. So not necessarily over the longer run, at least, did revenues necessarily decline by that much. Certainly got a little bit tighter, but you get the idea. Why did spreads decline? Well, I mean, if I was quoting a spread at $1.12 and a half, $10.125, and that was my ask price. My highest bid price had to be $10. I couldn't quote inside of this range. So as a result, even if the spread should have been narrower, let's say there were very low adverse selection costs, let's say there was a lot of volume in the marketplace, I couldn't get that spread to be smaller because I couldn't trade in pennies. Now, I could affect the percent spread by changing my share price. All right? So if my share price were very high, 12.5 cents is a very small fraction of $100 relative to a $10 share price. It's 10 times more percentage value of the share price, right? So we did see some effects there. But so it's not too surprising that decimalization led to a decline in spreads. In 2005, the markets automated and specialists lost their first right of refusal. And then by 2009, we got rid of specialists altogether. And now we have what's known as the designated market makers, the DMMs. We also have another liquidity provider. That's the supplemental liquidity providers, the SLPs. But the DMMs are really the key thing here, and they replace the specialist with some differences here. Now, DMMs, they were assigned a set of securities and obligated to maintain fair and orderly markets, which is similar to the requirements that the specialist had prior to 2009. What is different is that the DMMs could compete against other exchange members for trades. They could step in front of a person that walked up to them on the floor. Specialists had to step back. And unlike the specialist, DMMs do not receive an advanced look at the order flow, at the limit order book. So they don't have that informational advantage that the specialists had. So that's kind of the trade-off here. Quoting requirements were reduced as well. And the reason for that was that we've got these SLPs who can also step in and quote. So now the NYSE is much more like the Nasdaq. The Nasdaq has multiple dealers that can quote on a particular security. Now the NYSE is much more like that same structure. Other parties on the exchange, we've got commission brokers. Commission brokers execute customer orders. So there may be commission brokers for a particular brokerage house, and they execute orders for that brokerage house. Then we've got floor brokers, which are kind of, think of them as free agents, independent contractors, if you will. They would execute an order for any brokerage house. Let's say there was a spike in volume. The floor brokers might come into play there. And then the last group are the floor traders, and those are members of the exchange who just trade for their own account. And as I said, there are very few of those. It's a much smaller number. As far as computer systems, they've gone through a variety of iterations in upgrading the NYSEs. Used to be that SuperDot was around for a long time. Now they have the Super Display Book System, SDBK. And it's based upon ARCA, which was a company that the NYSE acquired a while back. Key thing here, 5 millisecond transactions. Pretty incredible. Remember, a millisecond is 1/1000th of a second. When you blink your eyes, that's like 200 milliseconds. All right. So transaction speed has gone up exponentially here. Their hybrid market is really what the NYSE kind of sells itself on. That and the prestige, right? You're on the big board, so there's still a bit of that. But the hybrid market is that human interaction piece. There's still a face-to-face floor. There's still a venue. Whereas Nasdaq and many of the other online electronic exchanges do not have any sort of physical presence. It's all on the computer. By the way, just a link here if you wanted to look at, this is all NYSE, so it's terribly biased, but they argue that their price is more efficient, that their spreads are smaller, and so on and so forth. And certainly the big board is still pretty much the big board. Look at these numbers, pretty incredible. 25% of the world's equity is still trading on the NYSE. 3,100 companies. There are some pretty strict trading listing requirements to be listed on the exchange. You can't just walk up to the exchange and say, hey, I want my shares traded on the exchange. You've got to meet a set of liquidity requirements. So there have to be minimum number of shareholders, minimum number of shares traded in a given month, and then some minimums in terms of market cap and income, variety, a few other criteria that they place upon firms that want to list on the NYSE. Order flow is king, and that's true of any market, whether we're talking NYSE or Nasdaq. Payment for order flow is de rigueur. It is kind of it's the usual. It's what we expect. That's what was happening on Robinhood, right? Payment for order flow. It's what happens on the NYSE. It happens on the Nasdaq. What is payment for order flow? Basically, it's the exchange saying, hey, you, broker, if you route 50% of your trades to my exchange, I'll give you a better deal. That's how we get deep discount brokerages, right? Because the actual cost is defrayed by a kickback from the exchange to the brokerage house. And then they pass that along to you and I as traders. So that payment for order flow, you'll see continuing on. Now, some of it gets a little excessive. You can, on most exchanges, you might tell me if any of you trade on Robinhood, whether you can do this, but certainly most brokerage houses will allow you to route a trade to a particular exchange. So if you're trading an NYSE listed stock, you can say to your broker, I want that trade to take place on the NYSE. I don't want you to run it off to some third market or fourth market. I want you to trade it on the NYSE. So that's a feature that when you're looking at opening up a trading account, you might be interested in, because I think there is something to the fact that NYSE does claim better price execution. Think back to that real estate example, right? Maybe I pay a little bit more in commission, but I get a much better price that offsets any of that additional cost in the transaction. Floor activity, picture is worth 1,000 words here. So this was back from the John Carroll student finance group trip back in January of 2019. So we got on the floor. And so this is a picture I shot from the balcony. And then we actually got right down on the floor. And then another kind of interesting quirk of the exchange, it takes place at 3:33 and 33 seconds, right before that period of time. Let me just play the video and you can see what this is about. Note the time here. 10, 9 seconds, 8 seconds. Dr. Navratil there. See any of your more senior colleagues there? So that's the whoop that takes place at 3:33 and 33 seconds on the Friday before a 3-day weekend. It was kind of interesting. But many old weird traditions on the NYSE that continue. Notice also how empty this floor is. Notice that right over here, this whole area, that is CNBC's studio. It is on the floor. This floor used to be shoulder to shoulder as recently as, well, for you guys, recent 1997 isn't really recent in your perspective, right? But it's pretty recent. As recently as, 2000 even, this floor would have been jam-packed with people. Now it's a TV studio. And yeah, to some degree, that is what it has become. There is still some face-to-face action, in particular in times of turmoil. That face-to-face transaction might be informative and might lead to a more efficient price outcome. Anyway, I thought it was interesting to think about that whooping hour. Various types of orders. Market and limit orders by far are the primary types of orders that you would place. A market order places emphasis on time. I want you to do that order. I want you to execute it, and I want you to execute it now, 5 milliseconds from now. A limit order says, don't worry as much about time. I'm more worried about price. I don't like the current price, but I am willing to trade at a different price. Now, I'm not going to go into any detail on stop or stop limit orders because what we find is that, and there we are. NYSE got rid of stop orders because there was some sense that it created additional market volatility, especially in times when the market was moving up or down dramatically. The reason for this, what a stop order does, is it's like a limit order in some regards, in that you don't like the current price. The difference between a stop and a limit order, though, a limit order will not necessarily execute even if the limit price is reached. So let's say that I place a limit to sell. The current price is $50. I place a limit order to sell at $55. Hang on a second. Let me just write this out. So current price, 50, and limit to sell at 55. Now, so here's our price plot. Here's 50. Here's 55. And this is just time. So price is moving around, bumps up above 50, and then starts cratering. I look back at this price plot and I go, I had a limit order to sell at 55, so I'm good. I was out at 55. Not necessarily. Suppose that only 200 shares traded hands above 55. And there were 300 shares in front of my limit order at 55. So 200 shares traded. There were 100 still in front of me, so my shares didn't trade. And now price plummets downward. So a limit order says, I'm placing more importance on price. Even if it hits that price, if the market's moving quickly, I might not execute at my limit order price. A stop order, on the other hand, just by virtue of hitting 55, that stop order converts into a market order. And it will execute no matter what at that point. Now, if the market's moving quickly, it might not execute until the price drops down here to 53 or even lower, depending on how quickly the market is moving and how little liquidity there might be. But I'm guaranteeing execution. If it hit 55, even touched it for just one share, it's going to convert my stop order into a market order, and then it will execute based upon time. There may be some orders in front of me because they have earlier timestamps, but as soon as my timestamp comes up, boom, order executes. So that's a key difference between these two types of orders, limit versus market. Or, sorry, limit versus stop. And let's see, what else? We're a couple of minutes left here. Yeah, so let's talk a little bit about, at least get started on Nasdaq. We're not going to get to the problems. So Nasdaq actually originally was an acronym. It is now a word. So I think even your authors use the capitalized. It's actually a word, so it's lowercase after the N, after the capital N, ASDAQ. Used to stand for National Association of Securities Dealers Automated Quotation System. And Nasdaq, like I said, is multiple dealer markets. There is no monopolistic dealer. They have a variety of marketplaces. They have particularly become attractive to the tech sector. It used to be that the big board was where everybody tried to get to. Now, many of the tech companies, even the huge tech companies, still stay on the Nasdaq. I already mentioned the inside quotes here, the highest bid and the lowest ask price. But you may have, and those two prices may be from different dealers. The highest bid and could be one dealer, the lowest ask could be a different dealer. Doesn't have to be the same person. And in fact, a dealer may only quote one side of the market. So they may only quote bids or only asks. They don't have to quote both sides of the market. But because we have multiple dealers, we end up with sufficient number of quotes up and down. The level 2 quotes we already talked about, and I think this is probably a good spot to stop, and we are at 1:45. So questions before we wrap things up? Make sure that you take a look at the, I've got a, let's see, let me go to web here. I'm going to go to modules, and I wanted you to, if you haven't already, I think I may have mentioned this before and we still haven't gotten there, but if you will take a look at, here we go. So under week 3, under the resources, how to read a value line page. Browse through that before class on Thursday, because we will definitely get to that on Thursday, and we'll start working some examples. We're going to use the value line page kind of as a one page that gives us all the information we need to do various types of valuations. So whether we're doing a relative valuation with PE or PCF, or whether we're doing a fundamental valuation using residual income model or the Gordon growth model, we can get all of our data off of this value line page. So there's the how to read it, and then there's also an example of a value line page. We'll be using this Amex value line page. Anyway, so take a look at that before class, and otherwise, if there aren't any questions, I will see you all on Thursday. Have a good couple of days. Bye-bye.
Thank you. Have a good one.
Thanks.
Thank you.
Thanks, Dr. Elliott.
Thank you.